Welcome to part 1 of variance analysis. So I'm going to make two videos. The first one will explain the general ideas you need to know about variance analysis, and then the second one will look at an example to help you consolidate the ideas. So to start with, we know that a budget is a plan, but things do not always go according to plan. And in accounting, when things do not go according to plan, we have what are known as variances. So things can go very well, and if they go better than planned, then you have a favorable variance. If they do not go according to plan and they get worse than the plan, then you have what's known as an adverse variance. Now, there are three main areas we are concerned with when it comes to variances. Actually, four main areas we are concerned with when it comes to variances. And the first one is sales. So we want to see whether we have adverse or favorable sales variances. And this information is important because you can only start taking corrective action if you know, and also be able to motivate people who are doing the right things if you know whether you have adverse or favorable variances. So we'll look at sales variances. We also need to look at material variances. So if you planned to use certain materials, did you actually use that amount of materials worse or better, and did you buy them at a good price or a bad price or at the same price as the one you planned for? The next one we need to look at labor variances, and then finally we'll look at overhead variances. And in terms of overhead variances, we will look at both fixed overhead variances and variable overhead variances. So let's get down with it, starting with sales variances. So with sales, there are two major variances you want to look at for the purposes of your course, and these are the sales price variance and the sales volume variance. I'll start with the sales price variance. With the sales price variance, you have a certain actual volume of sales that you make, right? You have a certain actual volume. I'll write actual volume twice here, and you may sell this actual volume at a certain actual price, but then you planned to sell this, so you're supposed to sell this at a certain standard price. The difference between this top part and the bottom row is what's known as the sales price variance. So we'll get that in. That's the sales price variance. Next, I want to look at the sales volume variance. So it's a sales volume variance. With the sales volume variance, notice here the difference is the price, but with the sales volume variance, you are concentrating on the volume. So you say you planned for a certain actual volume, but then you end up you have a certain actual volume, but then you planned for a certain volume. Your budgeted volume was different. and you could sell this volume at a certain, with the sales price variance, with the sales volume variance, you pay attention to whether you are using marginal costing and absorption costing, and I believe by now you already have knowledge of marginal costing and absorption costing. So with the sales price variance, you see whether, if you are using marginal costing, whether you sold this at a standard contribution. I'll actually just do this. I say you want to pay attention to whether you sold this actual volume at a standard contribution, I'll just write SC, or at a certain standard profit. Standard contribution in case of marginal costing, or standard profit in case of absorption costing. I want to get that right so that nobody gets confused. Or standard profit, or standard profit volume variance. So the differences between those two are going to give you a sales volume variance. I want to spend a bit more time on this. So that SC is standard contribution in case you're using marginal costing, while the SP is standard profit in case you're using absorption costing. So this is about sales variances. The next group of variances you want to look at is material variances, and for materials you want to look at the material price variance. So material price variance, and you want to look at the material quantity variance, material usage variance I mean. And actually here I have a shorter way of doing it, because so let's use a shorter way. So you have two types of variances here, and the way you want to calculate them is just say actual, and you say actual quantity. So you have quantity here, quantity and quantity. So you say actual, and then standard. You're going to multiply this by the actual price. So say actual, and then standard, and then standard price. So the difference between this line 1 and line 2, and the diff is going to give you the material price variance. Material price variance. And then the difference between line 2 and line 3 is going to give you the material usage variance. Material usage variance. So let's delete that and say material usage variance. variance. The goodness of doing this is that you know that this will always be quantity and this will always be price, and you just move from actual standard, and then actual standard, and then they'll give you that. Then the total material variances will be so let's say total material variances, to material variance will be the total of this one and this one. So that's how you do your material variances. The next set of variances that you want to look at is what's known as your labor variances. So like we saw in terms of labor, in terms of material, so for material you use quantity, right? But for labor you use hours. So here we went actual, then standard. Similarly for labor variances, let me just write that down. So for labor variances, you're just going to go actual, and then standard, just like we did there, actual, standard. But instead of quantity, for labor you use hours. So you say actual hours, and standard hours. Then, so remember, we went actual, then standard, and then so went actual, standard, and then we went actual, standard, actual, standard, then standard, actual. So even here we will go standard, and then actual. So standard, and then actual. But for labor, for materials we use prices, but for labor we are going to use the rate. So it's the labor rate that we use and not the labor price. So labor has a rate, so we say rate. And similarly, line 1 minus line 2, so actual hours times actual rate minus actual hours times standard rate is going to give us the here we had price variance, but this is going to be, here we had price variance here, so this is going to be the labor rate variance. So we'll say labor rate variance. And then when you get line 2 and subtract line 3, what you end up having is the labor efficiency. Going to have the labor efficiency variance. Now, unlike material variances, where we just simply add the material price and material usage variance to get the total variances, labor has an addition of variance. So for labor there's an addition of variance called the idle time variance. And so to find the total variance, you need to get the labor rate variance, labor efficiency variance, and the idle time variance if you have it. The idle time variance is going to be calculated as follows. You say idle time variance is going to be calculated as actual hours. So the actual hours that were worked, you compare these with the actual hours that were paid for. So here you're interested in seeing whether what people were paid is really what they worked for, and to confirm whether they are actually working. And you're going to multiply this by the standard labor rate per hour. So you multiply this as well by the standard labor rate per hour. So that's going to be constant per hour. And this answer here is what's going to give you the labor rate variance, the idle time variance. So the total of the labor rate variance, the labor efficiency variance, and the idle time variance is what will give you the total labor variance. Okay, total labor cost variance or something like that. The next variance that we're going to have is what's known as the variable overhead variance. So variable overhead variances. And for the variable overhead variances, we are going to do the same thing we've been doing for the other variances. So we'll say actual, and then standard. And for variable overhead variances, most of the times you'll be referring to labor hours, unless you're guided otherwise by a question or an actual scenario. So it will go actual hours, and standard hours. And you're going to be multiplying this by them. So we went actual, standard. Here we'll go standard, actual. And for for overheads, you're going to have an overhead absorption rate. So you need to use the overhead absorption rate. Again, if this is something that you're not familiar with, revisit your topic on overheads so that you're okay with that. And what you end up having here is, I shouldn't have actually drawn those. You end up with these first two lines are going to give you what's known as the labor overhead expenditure variance. So it's going to give you the variable overhead expenditure variance. And then when you subtract line 2 from line 3, you end up having the variable overhead variances, or variance, total variance going the sum of those first two variable overhead variances is going to be the total of those two. The next variance you want to talk about are the fixed overhead variances. And the two major fixed overhead variances, so we'll say fixed overhead variances, and the two major fixed overhead variances you want to think about are the fixed overhead expenditure variance. I'll just write expenditure variance, but we know we are talking about the fixed overhead expenditure variance, and this is simply the difference between the budgeted expenditure, budgeted fixed overheads, budgeted fixed overheads, and the actual fixed overheads incurred. And then, so that's the first fixed overhead expenditure, fixed overhead variance you can have. Then the next one is the fixed overhead volume variance. And for the fixed overhead volume variance, you need to get your actual volume. So the actual volume produced, and you compare this with the budgeted volume produced, and you multiply this by the fixed overhead absorption rate, and that is going to give you those figures that you then compare to get your total fixed overhead volume variance. A note here is that the volume variances, the volume variance, which is this one, is only applicable to absorption costing and not marginal costing, and that's why you notice there's fixed overhead absorption rate here. So you can only calculate the volume variances for fixed overhead volume variances for marginal costing, for absorption costing, And then the second thing is, or second note is that where you have hours, you can actually break down the fixed overhead volume variance. So fixed overhead volume variance can be broken down into two categories: the fixed overhead volume capacity variance and the fixed overhead volume efficiency variance. Okay, and to calculate each one of these, what you do for the capacity variance, multiply actual hours by the fixed overhead absorption rate, and your answer is there. Then compare this with the budgeted I hope that's how you spell it. The difference between these two is going to give you your fixed overhead capacity variance. Then for the efficiency variance, it's similar to the way you calculate your efficiency variance under variable overhead. So you say standard hours, you compare with the actual hours, and you're going to multiply this by the fixed overhead absorption rate per hour to give you your fixed overhead efficiency variance. So overall, this is a summary of the variances that you need to calculate and how you go about them. I will show them up here again. We've talked about the sales price and volume variances. We've talked about the material price and material usage variance. We've talked about the labor rate and labor efficiency variance, and then we've talked about the overheads. For the fixed overheads, in fact for labor we also included the idle time variance, and then for overheads, for variable overheads, we talked about the variable overhead expenditure variance and the variable overhead efficiency variance. The second variance there was the efficiency variance. And then for fixed overheads, we've talked about the fixed overhead expenditure variance and the fixed overhead volume variance. And we said this volume variance can be separated into the capacity variance and the capacity variance and the efficiency variance. So these are the variances you need to know, and in the next video we're going to do an example to see how you actually calculate these variances or apply knowledge of these variances to making decisions.